My name is Soumya Sarkar और आप देख रहे हैं Wealth Redefined blog. In today's blog, we'll be talking about that how market has reacted based on the statement made by the Fed. See, we have to understand that most of the stock markets all over the globe works on the liquidity as well as the valuation and earnings of the companies. Now, liquidity is one of the major factor which is increased or decreased by the central banks all over the globe. Fed, which is called the US Central Bank, is basically one of the major player in that particular market. So when Fed opens up the liquidity, obviously all over the globe you can see the stock market rally, and when they decrease the liquidity in the market, obviously the stock market reacts negatively. Now you have seen yesterday that Fed has given a complete path that how they are going to increase the rate. In US, the inflation has gone up almost 40 years high. So we need to control the inflation, because the central bank's main work is not to increase the growth but to control the inflation. So to control the inflation, they want the liquidity to getting out of the market. How they can get the liquidity out of the market? They will stop buying the bonds. So they will not print the dollar anymore. And to stop that thing, the easiest way is available is that increase the interest rate. So Fed yesterday has given a clear indication that from March onward they will start increasing the rate. As of now they are not increased, but March onward they will start increase the rate, because US economy is on the improvement path. So because there is a lot of good word about the job market. So US job market looks good, and that is one of the reasons that the Fed will start increasing the rate. Once increasing the rate happens, obviously the money will get sucked out of the market and liquidity will start falling. Once liquidity will start falling, obviously the assets are going to priced on a fair value. So that is going to that happened yesterday throughout the through all the global markets. If you look at the Nasdaq was trading approximately -2% before the Fed announcement, had gone up 4% positive, and then came back and almost closed at a flat rate. So this is the thing happens when there is a drastic changes in the market. Now, how you will understand that how to trade on that market? Though we do not recommend to trade in the market, but you should understand the VIX, that is called volatility index. If volatility index is very high, the trader should stay away from trading, because what happens is that the stop loss will get triggered at every time. So it can go like a pendulum from one side to another. Now, Indian market, where majority of the investors have invested in last 1 year or 2 years, they are going to see some kind of correction. So the major rally which has happened from 8,000 to 18,000 may not sustain completely. One good part about India is that where the investor base was approximately 1.5 CR to 2 CR in 2019-20, it has increased to approximately 7 to 8 CR by 2022. That means a lot of new investors have come in, and as they have come in, obviously new money also have come in. So people are not going to the offices, they are doing work from home. Partly they have the money which is getting saved because work from home and all those things. So they're putting the money, the expenses have come down because you cannot go to the mall, you cannot do the random purchasing and all those things. So that money which is saved is transferring into the equity market. And that is one of the best part of Indian equity market, is that the new investors have come in and they start putting the money. If you see the FII's withdraw from the market, it is almost approximately 1,30,000 crore, which is a huge amount. From March 2020 till approximately July 2021, they put approximately 2 lakh crore into the market. And after that they started taking out the money, and almost they have taken out approximately 1,30,000 crore into the market. So in these kind of things, the market should have seen a major correction. It could have come approximately around 12,000 level or 11,000 level, but it did not. The reason it did not come is because of the moving of the new generation investors who kept on supporting the market, the retail investor. Massive money is flowing through SIP's way, because people now realizing the power of SIP and how they can beat the inflation with a systematic investment in equity. Based on those knowledge and everything, the market has stabilized. But can we see this kind of return further? I have a doubt on this, that we may not see 8,000 to 18,000 kind of a return further. Definitely we may see a muted return, probably approximately 10 to 12% return on a regular basis. And I think the company earnings are going to play a major role in that segment. We have seen that some of the banks have done very well, some of the companies like Reliance have done very well, but that needs to go across board. And in India, budget will play an important role, that how FIIs or foreign investors are going to come in. Where if you are an investor in mutual funds, I think you may do it in a staggered way, that every market fall you buy something. SIPs are the best way to do it. And you have to understand that if market's falling, okay, you need to buy. You cannot sell or panic and go, because that really won't help you to make the money. It will only help you to make the money when it keeps on, you buy at a different dips. Dips may not be that big at times, dips may be small, dips may be medium, and you need to keep on buying it. But if you are planning for a goal-based approach or everything, you must talk to your financial advisor and your investment advisor to know how to go about it, whether you should invest into those things. If your assets are riskier, you should reduce the riskier asset to a non-riskier asset or a moderate riskier asset. If your goal is near, if your goal is far away, you may continue with the riskier asset. But I would recommend you don't always go by the past performance of the fund. Past performance sometimes doesn't make much sense, because probably fund manager has taken the risk, but he could not get out of the things. So it may not be a helpful thing. Obviously, fund manager's track record matters the most, that how he has done well in past falls and all those things. But that you can get it through a lot of softwares which are available. But I would recommend you don't only go through the past performance of the fund. You must talk to your advisor, and he may recommend you a better fund for you. Thank you for watching this video. If you have any queries, you may come back to us. You may write a comment, or you can send us through email or mobile. We will try to give you the response. Thank you very much again for watching the video. If you like it, please subscribe it. Namaskar.